Oil surges 5% to two-week highs after the US sanctions Russian oil exports. Gold rises too. Markets will focus tonight on delayed US inflation data that the Fed watches closely. And inflation in Singapore is surprisingly strong. That's coming up in our 5 Things in 5 Minutes on Friday, October the 24th. And then in our deep dive interview, ANZ Economist Dhiraj Nim analyses the depreciation of India's exchange rate.
Because tariffs are very much there in the global trade picture, we think that competitiveness should be the medium-term guide for the exchange rate, and the RBI should let the rupee weaken in a calibrated manner.
But first in 5 and 5 with ANZ, geopolitics continues to push markets around. Oil prices bounced 5% overnight after the United States announced new sanctions on Russian oil exports in the hope of forcing a ceasefire in Ukraine. ANZ's head of G3 Economics, Brian Martin, describes the ripple effects overnight from London.
That rise in the oil price had a small spillover effect into the bond market, which saw yields rise marginally. However, the main focus for markets is now very much on the CPI data that will be published in the US for September and other data that we get on the PMI and consumer confidence as well.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.5%, the Nasdaq up 0.8%. The yield on the US 10-year Treasury was up 4.9 basis points to 4.00%. West Texas oil futures rose 5.9% to $61.97 a barrel. Gold was up 2% at $4,151 US dollars an ounce. The US dollar index up 0.1%, the Aussie dollar up 0.4% at 65.14 US cents, and the Kiwi rose 0.2% to 57.49 US cents. Number 2. ANZ senior economist Tom Kenny says those US inflation figures due tonight are likely to show headline inflation for the month of September was 0.3%, which would leave annual inflation unchanged at 3.1%. He says goods price inflation is higher than the long-run averages, but the services inflation, that's watched closely by the Fed, is subdued.
We expect core services ex rents to continue to trend lower as the labour market is soft, while rents are also expected to ease. We don't expect the September CPI data will change the monetary policy outlook. The dot plot has 50 basis points more of easing this year, and the market is fully priced for 2 25 basis point cuts.
Number 3. The Bank of Korea left rates on hold at 2.5% yesterday, as expected. ANZ economist Crystal Tan says the decision reflected persistent concern over rising house prices and volatility in the foreign exchange market.
So the Bank of Korea did acknowledge that the overall economic backdrop could support a rate cut, but its tone suggests that it will be moving more cautiously than before. There's a stronger emphasis on financial stability now, and the board has turned less dovish, with 4 out of 6 members, excluding the governor, open to a rate cut in the next 3 months. This is down from 5 at the last meeting in August. So overall, unless we see a new shock to growth, it's looking like the Bank of Korea is more likely to cut rates once more rather than twice, and probably in the first quarter of 2026.
Number 4. Singapore's CPI inflation came in above expectations in September for both the headline and core measures. Here's ANZ Head of Asia Research, Koon Goh.
This is the first time in a while that inflation has surprised to the upside. The headline inflation rate rose to 0.7% year-on-year from 0.5% the previous month, while the MAS core inflation increased slightly to 0.4% year-on-year from 0.3% in August. The main upside surprise came from retail goods prices, which showed a larger than expected increase, especially for clothing and footwear and household durables.
Number 5. Koon says the results suggest Singapore dollar strength is no longer putting downward pressure on tradable prices.
Inflation looks to have bottomed in August, and we expect both headline and core inflation to continue rising from here and into 2026. This is consistent with the MAS's latest projections contained in their October monetary policy statement. Overall, with inflation now looking to pick up, we expect the MAS to be comfortably on hold in terms of monetary policy, and we do not see them adjusting their policy stance for the foreseeable future.
Koon Goh there. Now, in our deep dive interview, ANZ economist Dhiraj Nim looks at how India's rupee has been allowed to weaken and what a trade deal with the US could mean for the currency.
Year to date, the Indian rupee is down about 2.5%, but until a week and a half ago, before the Reserve Bank of India intervened, it was about 3.3% the value of the rupee that it had lost against the US dollar. Now, this is in stark contrast with the rest of the Asian currencies' performance, which on an average have gained about 2.5% year to date. And most of the rupee's weakness actually started from July when India-US trade tensions flared up. The interesting thing that has happened happened is, while the US-India trade tensions flared up, it was reflecting mostly in financial account weakness, that is the portfolio outflows, especially from the equity markets in India. And therefore, there was a bit of a pressure in Q3 on the rupee from the balance of payment perspective.
And what's been happening to India's trade during this time?
If you look at the data for Q3, if you stitch it together, we find that India's aggregate trade balance has actually slightly improved, thanks, of course, to a stronger services trade surplus. And, it is certainly benefiting from the advancement in artificial intelligence in developed markets. And, even the World Bank noted that India's services exports are actually poised to benefit from the global advancements in AI. And also the goods trade deficit has more or less steadied or sterilized. Of course, it's running high in the monthly terms in the range of about $25 to $32 billion, but it has more or less steadied in annual terms. That is a 12-month rolling average, or whichever way you want to cut it. The interesting aspect is that even if you exclude the exports to the US, which would have likely benefited from the front-loading effect due to tariffs, the aggregate trade balance for India seems to have improved. So that's number one. The second is the net FDI rebound, which has actually been quite healthy. Now, between April and July, the data for the months that are available, we see that net FDI in India sprang back up to about $11 billion. This is after it virtually evaporating to zero towards the end of last fiscal year. And it is coming on the back of a healthy rebound in inward FDI, which had dried up, and a slowdown in outward FDI, which had initially increased a lot. So overall, the composition of net FDI has also improved, and so have its number. Therefore, India's basic BOP position has substantially improved, which begets the question that is the weakness of the rupee really warranted?
So what role has the Reserve Bank of India played in this?
Now, the role that the RBI has played in all of this is that quite breaking away from its usual tendency to prevent currency fluctuations on account of portfolio flows. This time around, the RBI has let the rupee weaken from July onwards on account of financial outflows. Now, this is possibly an admission or a revealed preference to have a competitive exchange rate, because exporters in critical sectors such as textiles, gems and jewelries, which are very employment intensive, are facing the risks due to tariff, and therefore a weaker exchange rate to whatever extent is possible while safeguarding macroeconomic stability. It would cushion their local currency earnings. So therefore, I think the Reserve Bank of India, in letting the rupee weaken this time by about that 2.5%, has actually revealed a preference for a competitive exchange rate.
So now what happens if India does secure a good trade deal with the US?
The occurrence of a trade deal between India and the US could set the stage for a short-term rally in the rupee, and we think it would be of a limited nature. The primary reason behind our thinking is that competitiveness should nevertheless be the medium-term guide for the central bank in thinking about the exchange rate. Look, even if the tariffs are halved to about 25%, it would still mean meaningful compromise in terms of competitiveness of Indian goods in the US. So we will still need a weaker exchange rate to cushion those sectors, even though the relative disadvantage that India currently has at 50% tariffs would be substantially reduced. But because tariffs are very much there in the global trade picture, we think that competitiveness should be the medium-term guide for the exchange rate, and the RBI should let the rupee weaken in a calibrated manner, in a very moderate pace over the medium term. And we see the rupee at about 89 by Q3 of 2026. It is currently where we had projected it to be, around 88.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, October the 24th. Catch you next week with all the detail from that US inflation data tonight and what it could mean for the Fed. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.